Are you getting ready to retire and not sure how to transition from a paycheck to retirement income? How does it work? Where does my income come from? How much tax am I going to pay? For most of you, for pretty much all of you, when you hit retirement, you're transitioning from one income stream to 2 to 4, maybe even up to 8 or 10 income streams. You have your CPP, OAS, pension plan, RRSP, LIRA, non-reg account. You might have a rental property. There's a lot of income streams. And unfortunately, they don't work together naturally. You have to figure out how they're going to work together, how much tax you're going to owe, and then come tax time, are you getting a refund? Are you paying tax? A good financial plan will map that all out. But what are the first steps? Let's go through that. So the first step is to look at what types of income you're going to have. And in this video, I'm going to break down the 4 main types of income because that's most of you, 99% of you, and it doesn't matter what size of accounts these are, it's the same process and principles for each one of you. So the very first one we're going to look at is CPP, or the Canadian Pension Plan. And we have many videos on the Canadian Pension Plan. We talk about it, when's the best time to take it, all of that. The Canadian Pension Plan is a government paid pension plan. You've paid into it, so it's a plan that you've paid into it, and how much you get out is based on how much you paid in. So if you paid in fully your whole life and you're retiring at 65, you're going to get a fair amount, just over $1,200 a month. You might get 100 or 200 if you didn't pay in much. So it all depends on how much you paid in. Now, you'll get a statement and you can log into your CRA account, but you'll also get a statement when you turn 64. And that will show you, in 1 year from now, if you start CPP, here's how much you'd get. There's also online calculators, cppcalculator.com. It's a great place to go. Again, we'll link that calculator below. It's a wonderful tool. You can put in your earnings and figure out, okay, if I keep working, how much is my CPP going to be? If I stop working now, what's it going to be at, 60, 65, 70? What's the best decision there? All of that is in that calculator, so we'll link that below. Your CPP, you can take anywhere from 60 to 70, anywhere in between that. If you take it before 65, it's reduced by 0.6% per month. And if you delay it or defer it, it increases by 0.7% per month. So as you put together your financial plan and you hit retirement and you look at timing and when to take that, again, your CPP is one silo, income silo I call it, of your overall retirement income. You need to figure out how much you're gonna get and when the best time to take that. And then when you do start taking it, you can have tax withheld or not. So you want to figure out, how does this integrate into your overall plan? How much tax should I ask CRA to hold back on my CPP? That's also a question that you need to figure out or work with your advisor to figure out. Income number 2 is also a government income stream, but it's old age security. And it's not based on how much you pay in, it's based on how long you were in Canada. And if you were in Canada for 40 or more years beyond age 18, then you will get full old age security payment. If you're less than 40 years, it'll be prorated. So you can probably try and figure out that calculation. Again, if you were in for 30 years up to age 65, then you're going to get 75% of the maximum old age security amount. Again, the old age security is a little bit different. You can start it at 65 and not earlier. You can also delay it all the way till 70, but the benefit to delay is only 0.6% per month versus 0.7. So there's not as big of a benefit versus CPP. Old age security will automatically start at 65 unless you tell them otherwise. So if you don't plan to start your old age security at 65, when they send you that letter prior to 65, make sure you respond back to say, no, I would not like to start it. I will start it at a future date. Now, typically you want to delay old age security if you're still working and or have a decent income, because there's something called OAS clawback. And that's if you're over a threshold, in 2023, it's about $86,000. If you're over that threshold, for every dollar above that threshold, you lose 15%. You can work out the calculation, but if you're over that threshold, you may want to consider delaying or deferring that old age security. Otherwise, probably good to start at 65 for most of you watching this video. The third income stream you really want to look at and consider in the overall cash flow plan of your retirement is your employer pension plan. And you're probably sitting there saying, Adam, I wish, and it's true. Most employers do not have defined benefit pension plans like our parents and grandparents had. Many companies previously had defined benefit pension plans, which is a defined benefit plan means that you get a defined benefit in retirement, i.e. a set payment amount for the rest of your life when you hit a retirement age. Unless you work for the government or a really big corporation, you probably don't have a defined benefit plan. Now, if you do have a defined benefit plan, let's quickly touch on that. So if you have one, you want to look at when is your earliest unreduced pension. Is there a benefit to delay it further? I've seen pension plans where if you take it at 60 or 65, you're getting the same amount. So you might as well start it at 60. Now, if you have a defined benefit pension plan, your work will likely have on an annual basis some sort of conference or seminar that talks about how the pension plan works. You want to go to those. You want to start digging into and learning about your pension plan. How does it work? Is there benefits to work longer? If there's not, that's very important. Are some of the other health benefits included with it? Like if you work past 55, you also get your health and dental benefits for life. Things like this matter. You want to dig into your defined benefit plan. Now, for those of you that don't have a defined benefit plan, which is most of you watching, then you want to look at, did you have a matching group RRSP at work or a defined contribution plan? Again, a defined contribution is you define how much you contribute, but how much you get in retirement is not defined. It's based on how much you put in, the performance of the investments and all of that. If you leave your company and you had a defined contribution plan, which would be a lot of you, then when you leave, it's gonna roll into what's called a LIRA, locked in registered account. At times, it can roll into an RRSP. Talk to your HR person to figure out where does R go? Does it go to a LIRA or an RRSP? Hopefully it's an RRSP, but most of them will be a LIRA, locked in registered account. With that LIRA account, you can then convert it to a LIF, a life income fund, and that provides a set amount of income for you for the rest of your life. When you process that LIRA to LIF, there's a very important step. Now, don't miss this. When you convert to a LIF, if you're able to unlock any of that LIRA, you want to do that. Now, what I mean is unlocking it is moving some of it to your RRSP, which is going to give you more flexibility in retirement and as you move forward. You can visit parallelwealth.com/LIRA, and we have it all laid out on which provinces allow unlocking. So step number one is if you have a LIRA, figure out which province or territory your LIRA is licensed in or registered in. So let's say it's registered in Alberta. In Alberta, you can unlock 50% of your LIRA, meaning that when it's time to take income out of it and you convert from the LIRA to a LIF, let's say you have $100,000 in your LIRA and you move it to your LIF, 50,000 can move to your RRSP and 50,000 would move into the LIF. Same with Ontario. Manitoba, Saskatchewan, you can do 100%. In BC, we can do 0%. So we're out there. So make sure if you can unlock your LIRA, you unlock as much as you can. Now, why do you want to do that? Again, when you look at a LIF account, a life income fund, it has a minimum you have to take out, but there's also a maximum. So there's more constraints on that account. Whereas if you can get some of that money into an RRSP, that converts to a RIF, or retirement income fund, which has a minimum but no maximum. So there's much more flexibility on that account. So if you look at your statements and you're like, yeah, I have a LIRA, you want to start doing some digging on which province is registered in, can you unlock it, and how does that process work? Start doing homework on your end or talk to your advisor to figure out what the best solution is for you and your account. And that ties us into the fourth and final income stream that most of you have, which will be your personal savings and investments. And so hopefully, as you've built up to retirement, you've been building up an RRSP, a TFSA, and maybe a non-registered account, maybe more than that as well, a spousal RRSP, something like that. When you hit retirement, it's now time to start drawing out. And I will tell you this will be the hardest transition for you. Is you've been saving all your life, and now it's time to draw it all out. And that psychological shift is very, very challenging. I see it day in and day out with all of our clients. If I tell them, look, you need to take out this money from your RIF, whether you need it or not, it's a tax play. And B, you can go spend all this money. It's still hard to wrap your head around it because you've been forced to save $5,000, $10,000, $15,000 every single year to get to this point, and now you're emptying it out. It is a very tough transition. So as you go through the first year or two of retirement, if you're having trouble with it, if it's challenging, that's normal. You're in the larger bucket here. If it's easy to spend your money, perfect. That's great, but that's not the norm. It's where it's important to make sure you have a clear plan so you know how much, from where, and what it means down the road. Like, am I pulling out too much? Is it going to cost me my retirement down the road? You want to know all these things. So a clear plan will give a bit more of a clear mind on, yes, I can pull this money out and spend it freely. Now, when you look at your personal savings, hopefully as you get to retirement, you have, let's say, an RRSP and a TFSA. Now, build up that TFSA. I always talk about that. It's very important to have a bit of a TFSA as you enter into retirement so that you have that income flexibility and tax flexibility to draw money out of there, right? If you need a bit of money for a bigger trip one year, an emergency fund, whatever it is, You can pull that lump sum out of the TFSA if you need to and not trigger a big tax bill. So very important. If you have an RRSP, that's gonna convert to a RIF, a retirement income fund. Now, a lot of people ask me, okay, do I have to sell everything in the RRSP and rebuy it in the RIF? No, you don't. If you have a stock or mutual fund or whatever the investment is currently in your RRSP, all you're doing is setting up a RIF and you're moving those investments over. There's no taxable event, anything like that. You're just putting a new umbrella over top of those investments. That's all you're doing. So you don't have to sell or change your investments or anything like that. Now, again, you probably want to talk to your investment advisor as you get into retirement to see, am I structured properly? Like, I'm drawing down my accounts. Is my account structured in a way, my investments in a way that it's going to allow for the proper cash flow? Am I going to have to sell something when the markets are down, or is it providing that ongoing cash flow that I need? So again, I always focus, cash flow in retirement is very important. I would say focus on cash flow more than your overall investment risk, like how much stocks versus bonds versus other. So you'd have your RIF income, you'd have your TFSA. If you had your defined contribution plan, now you have a LIF income, you have CPP, and you have OAS. Now, the goal is to make all of these funnel in and work together to pay the least amount of tax, to put the most amount of after-tax money in your pocket, and create efficiency in your overall plan. Now, again, the timing of when you take from where and how much and all that, you need to figure that out with your financial advisor or work through it yourself. Don't forget about inflation. Look at conservative rate of return. You got to look at your tax situation. You got to look at life expectancy. And we're going to do a video on that coming up, talking about life expectancy. And a lot of you are looking at this the wrong way. A lot of comments I get on any CPP video I do. I said, Adam, I took my CPP at 60 because if I died at 61, I would have gotten nothing. But how much is that costing you down the road? You need to do these exercises. A lot of you jump into these decisions without mapping out the numbers. So again, look at all your income streams. How does it flow together? How does a tax situation work? As far as your personally managed investments, talk to your investment advisor to make sure, do we need to make a change as we head into retirement? For a lot of you, you do. For some of you, may not. Again, the one thing you need to focus on there is cash flow.